When the financial world was celebrating endless growth in the early 2000s, one man was quietly preparing for disaster. Michael Burry, the eccentric and deeply analytical investor portrayed in The Big Short, was not fooled by the optimism that swept through Wall Street. Instead, he was reading balance sheets, mortgage data, and behavioral patterns that painted a very different picture, a picture of impending collapse. But how did Burry see what no one else did? How did he recognize the warning signs of a market bubble before it burst? To understand this, we must step into the mind of an investor who prioritizes logic over emotion, facts over hype, and reality over illusion. Burry's ability to predict bubbles stems from his deep understanding of human psychology and financial fundamentals. He understood that markets are not efficient, as economic textbooks once claimed. They are emotional, irrational, and driven by greed, fear, and the illusion of control. Burry's genius lies not in predicting specific events but in identifying patterns of collective delusion, the moments when investors collectively decide to ignore risk in pursuit of easy money. In the early 2000s, the U.S. housing market looked unstoppable. Home prices were rising rapidly, credit was easy to obtain, and financial institutions were making record profits packaging subprime mortgages into complex securities. To most, it seemed like a golden era. But to Burry, it was a ticking time bomb. He noticed something alarming in the mortgage data. Loans were being issued to people with little to no income verification, poor credit histories, and adjustable rates that would soon reset to unaffordable levels. While others focused on the surface booming prices, high returns, Burry dug deeper. He saw that the entire system depended on one fragile assumption, that home prices would keep rising forever. The first warning sign, according to Burry's framework, is complacency. When investors start to believe that risk has disappeared, danger is near. In every major bubble, from the dot-com era to cryptocurrencies, complacency acts as the fuel that inflates valuations beyond reason. Burry recognized that complacency leads to a distortion of risk perception. People stop asking, what could go wrong, and start believing, this time is different. He viewed that phrase as the deadliest sentence in finance. The second warning sign is leverage. Easy credit is the oxygen of a bubble. When borrowing becomes effortless, it amplifies both optimism and potential losses. Burry studied the leverage ratios of mortgage-backed securities and realized that the entire system was built on borrowed money. Banks were lending recklessly, assuming they could always offload the risk onto someone else. He saw how debt magnified fragility. One small shock could cascade into a systemic collapse. The third sign Burry identified is detachment from fundamentals. When investors stop caring about earnings, cash flow, or intrinsic value, and instead chase narratives and momentum, a bubble is forming. In the housing market, no one was analyzing the quality of loans anymore. They were trading derivatives of derivatives, bets upon bets, completely detached from the underlying assets. To Burry, that was madness disguised as innovation. He often said, "It's not hard to know what will happen, it's hard to know when." Timing the crash was never about luck for him, it was about identifying the exact moment when confidence would evaporate. He began buying credit default swaps against mortgage bonds, a move that baffled even his investors. They accused him of being reckless, of wasting their money on obscure instruments that no one understood. But Burry's conviction came from evidence, not emotion. He was willing to be misunderstood because he knew that truth takes time to be recognized. So, what can we learn from this mindset? Burry's approach teaches us that markets often send subtle signals before a crash, signals that most ignore. The question is, would you have listened? Burry's early warning system for market bubbles was not based on instinct or vague predictions, it was grounded in rigorous analysis and skepticism toward consensus thinking. He was, in many ways, a data detective. Each bubble has its fingerprints, and Burry learned to spot them by asking questions that others refused to ask. For him, the first step was always to look beyond the narrative. Narratives, as he saw them, are dangerous because they create emotional comfort. During the dot-com bubble, the narrative was technology will change everything. During the housing bubble, it was real estate never loses value. These stories contain partial truths, but when they become investment theses detached from numbers, they lead to disaster. Burry's first principle was to challenge popular assumptions. He once said, "If you're seeing it on the cover of a magazine, it's already too late." Popularity is often the final stage of a bubble, not the beginning. In 2006, when financial media praised mortgage innovation and rising homeownership, Burry saw those same trends as signs of excessive optimism. His second principle was to follow the data, not the crowd. He spent endless nights reading mortgage prospectuses line by line, thousands of pages filled with complex financial language that most investors ignored. What he found was staggering: pools of subprime loans with shockingly low credit quality. He realized that Wall Street's confidence was built on the false assumption that housing prices would never fall nationwide. To Burry, this was a statistical impossibility. He saw the discrepancy between reality and perception, and that's where opportunities are born. The third principle in Burry's playbook was independence of thought. He believed that real insight comes from solitude, not social validation. At Scion Capital, his hedge fund, he rarely interacted with other investors or attended conferences. Instead, he trusted his models, his research, and his logic. This independence came at a cost. His investors doubted him, major banks mocked him, and he faced immense pressure to abandon his contrarian stance. Yet, his resilience in the face of collective denial defined his legacy. What makes Burry's story compelling is that his success was not about predicting one crisis, it was about developing a mindset that sees through illusion. He applied the same framework to later events: the student loan bubble, the rise of passive investing, and even cryptocurrency mania. In each case, he warned that unchecked enthusiasm and debt-fueled speculation would lead to pain. His warnings were often dismissed, just as they were before 2008. But history has a way of proving the skeptics right eventually. What Burry teaches us is that markets are mirrors of human behavior. Every chart, every price movement, reflects the collective emotion of millions of participants. When fear disappears and everyone believes in infinite growth, danger is lurking beneath the surface. So how can you, as an investor, apply Burry's lessons? Start by asking uncomfortable questions. When everyone is bullish, ask why. When valuations seem too good to be true, assume they are. When leverage is high and due diligence is low, tighten your risk management. Remember that bubbles don't announce their arrival, they whisper through subtle distortions in logic and data. The investors who survive are those who listen carefully. If Burry's early years were defined by his discovery of hidden dangers, his later philosophy revolves around discipline and humility. Predicting bubbles isn't about arrogance or brilliance, it's about recognizing human weakness. Burry's worldview is built on the assumption that most people will always overestimate their intelligence during good times. They see patterns that aren't there, justify irrational prices, and mistake luck for skill. He saw it in 1999 with tech stocks, in 2007 with real estate, and again in every speculative boom since. The warning signs of a bubble, in his view, always repeat: exponential growth curves, media euphoria, dismissal of skeptics, and widespread belief that this time it's different. When all four align, Burry believes the crash is inevitable. He often references historical parallels: the South Sea bubble, the 1929 crash, Japan's 1980s asset boom. In each case, the pattern was the same: innovation mixed with greed and leverage. What set him apart was his ability to stay patient while others lost discipline. Patience is a rare virtue in finance. Burry was willing to be early, to suffer temporary pain for long-term reward. During the years leading up to 2008, his investors demanded he reverse his short positions. They accused him of being stubborn. Yet, his refusal to conform was what saved them in the end. When the housing market finally imploded, Scion Capital's returns exceeded 400%. Still, Burry's victory came with exhaustion. He closed his fund shortly after, citing frustration with the emotional instability of investors. The irony of predicting a crisis, he noted, is that people only believe you after it happens. From that point on, his focus shifted to warning about future systemic risks: corporate debt, passive index bubbles, and government spending. He often communicates through short, cryptic tweets, echoing the same message: people learn nothing. This statement captures the tragic cycle of markets. Despite all the lessons, data, and history, human behavior resets after every bull run. Burry's insight is that financial markets are less about numbers and more about psychology, the eternal battle between rational analysis and emotional impulse. The next time you see a booming sector or a can't-miss opportunity, ask yourself, would Burry see a bubble here? Are the fundamentals real, or are they illusions inflated by narrative? The beauty of Burry's approach is that it empowers you to think independently. You don't need to predict the future, you just need to recognize when the present stops making sense. His story is not about fear but awareness. By reading warning signs early, you don't just avoid losses, you position yourself to profit when reality returns. The question that remains is not whether another bubble will form, it always does, but whether you'll see it coming. As the dust settled after the 2008 financial crisis, Michael Burry emerged not as a celebrity investor seeking fame, but as a reluctant prophet of rationality. While Hollywood immortalized him in The Big Short, Burry himself retreated from the spotlight, returning to the quiet world of numbers, data, and unfiltered truth. His journey did not end with a single prediction, it evolved into a philosophy about understanding cycles, risk, and the human condition. What makes Burry's perspective so valuable is that it strips away illusion. He doesn't see markets as mathematical puzzles to be solved, but as mirrors reflecting collective emotion. Every asset bubble, from tulip mania to Bitcoin, is a psychological story disguised as an economic one. And if you listen closely, each story follows the same rhythm: hope, euphoria, denial, and collapse. To Burry, this is not pessimism, it's realism. He believes that true investors must embrace discomfort, must question narratives that feel too perfect, and must train their minds to operate independently of crowd emotion. The warning signs of a market bubble, therefore, are never truly hidden, they're simply ignored by those who don't want to believe. When investors chase trends instead of truth, they become participants in a self-reinforcing illusion. Burry calls this the madness of crowds. It's the point at which price replaces logic, and popularity replaces value. But here's the paradox: Burry's greatest strength, his skepticism, is also what isolates him. In a world that rewards conformity and short-term thinking, the independent mind becomes both powerful and lonely. His story reminds us that insight often comes at the cost of belonging. Yet that solitude is precisely where wisdom grows. Consider his recent warnings. Long after 2008, Burry continued to ring alarm bells about excessive corporate debt, speculative cryptocurrencies, and the blind faith placed in passive investing. Each time, he faced ridicule. Critics labeled him alarmist or outdated. But history has shown that his patterns of analysis are deeply rooted in timeless principles. When leverage increases, transparency declines, and risk becomes invisible until it's too late. The brilliance of Burry lies in his ability to see the invisible, those quiet distortions that signal instability before the masses can feel it. He looks for the hidden consequences of collective optimism. For example, when governments inject liquidity to stabilize markets, Burry asks, at what future cost? When investors claim technology will solve all inefficiencies, he wonders, what if it magnifies them? His thinking is always one step removed from consensus, what Howard Marks might call second-level thinking. But for Burry, it's not just intellectual, it's moral. He believes that ignoring risk is a form of dishonesty, a refusal to face reality. This moral dimension is what sets him apart. For him, predicting bubbles is not about profiting from others' pain, it's about understanding how systems built on denial inevitably collapse. Burry's fascination with value, debt, and cycles all point toward a central idea: reality cannot be escaped, only delayed. Markets may run on emotion for years, but eventually gravity returns. The question is whether you'll be standing when it does. The final warning sign in Burry's philosophy is distorted incentives, when financial success becomes detached from productive outcomes. Before every crash, people make money not by creating value, but by manipulating perception. In the housing crisis, it was bankers selling toxic loans. In today's markets, it might be tech companies inflating metrics or investors buying stocks they don't understand. Once profit depends on illusion, collapse is a matter of time. What makes Burry's analysis so compelling is its relevance across eras. His framework applies not only to housing or stocks but to any domain where optimism blinds rational judgment. He teaches that bubbles are not accidents, they are consequences of ignoring truth. Every crash is a correction not just of price, but of perception. The lesson he leaves us with is both sobering and empowering. Don't fear downturns, understand them. Don't chase trends, question them. Don't seek certainty, seek clarity. Because the investors who endure, the ones who protect and multiply their wealth, are not those who follow the crowd but those who stand apart from it. In the end, Burry's greatest insight may not be about markets at all, it's about human nature. The cycles of greed and fear, boom and bust, are reflections of our inability to stay rational in a world that rewards noise over thought. His message, then, is a challenge. Can you remain logical when others lose their minds? Can you see truth when everyone else sees profit? The future will bring new bubbles, new technologies, and new forms of speculation. The faces will change, but the psychology will not. Somewhere, someone will be the next Michael Burry, alone, doubted, and reading the data no one else wants to see. The question is, will you be one of those who laughs at the warning signs, or one of the few who listens? And that's the real lesson behind Michael Burry's story. True investing isn't about following the crowd, it's about understanding why the crowd is running. Burry showed us that instead of fearing market crashes, we should learn to read them. Because opportunities often appear when everyone else is panicking. If you want to develop a mindset where logic, not emotion, guides your investment decisions, there's a lot waiting for you on this channel. For more videos on rational investing, market psychology, and the timeless strategies of great investors like Warren Buffett and George Soros, subscribe to the channel. Like the video. Share your thoughts in the comments. Because remember, sometimes the most profitable move is to think when everyone else is silent.